Let's talk about some ways that we can save you some money. So if you are a charitable person, there's multiple different ways to do this. And a lot of people are just doing the general, hey, I'm going to give some cash. And honestly, they don't quite understand it. So I want to go through a little bit of just the breakdown of how it all works from a tax deduction standpoint. Then we'll go through all the different strategies. And, let me know if you have one strategy that you do that you like the best, or, maybe there's something you learned from this that you'll start doing now. So if that's the case, let me know in the comments, and let's go over to the handy dandy board and let's talk about this for a minute. All right, so the first thing we have to understand is something called standard deduction. Now, some of you already know exactly what this is. Some of you may not, or some of you get confused with how it all works. But if you're a single filer in 2023, your standard deduction is $13,850. If you are married filing jointly, only if you're married filing jointly. If you're married filing separate, totally different. But if you're married filing jointly, $27,700. That's your standard deduction. So a lot of people don't quite understand, because what they end up doing is they say, hey, you know what? I'm going to give $10,000 to a qualifying charitable organization, a 501c3. And now I've made $100,000 this year. So they say, all right, cool. I've made $100,000. Well, I get my standard deduction. I'm married. Now we're going to subtract out $27,700. And then guess what? I gave $10,000. We're going to subtract out $10,000. Then we have our balance. Not the case. Instead, the $10,000 actually doesn't count whatsoever. The reason for that is because it's anything over the standard deduction that actually counts. Some people don't quite understand that. When it comes to tax liability, I always say in general, the federal rates favor married filing jointly, but this is one not so much, because if you're making $100,000, you only have to give $13,850 to be over the standard deduction. Now, one other thing though with this to make sure that you understand is if you made $100,000 and let's just say your standard deduction is $13,850. Let's say you gave $13,850. Well, some people say, well, awesome, I've met the standard deduction, so now I get to take it plus take whatever the charitable contribution I made was. That's not the case either. It's a break even. So what happens is it's anything that's over the standard deduction. That's what you're then able to reduce your tax liability by. So just make sure you understand that. This does include other things that you can itemize, such as mortgage interest. Right now, if you signed up for a new mortgage, you've probably got a really high interest rate. So if you are able to itemize, you can take the standard deduction or remove the standard deduction, take the charitable donation, plus you can take the mortgage interest as well. So a couple little things there. Chat with a CPA. You can really figure that out. But that's just a little bit of a breakdown. All right. So what most people do, they just give cash to a charity, hope that they're over the standard deduction. They can take an amount. Well, you're allowed to take in 2023, 60% of your adjusted gross income in cash can go to a charitable organization, and you can take that as a deduction. Now, the thing is that's a great option, but there's other things that are out there that a lot of people aren't aware of. So here are a few that I want to go through here. There is the donor advised fund. And so that's one of them. I'll break that one down for you. A QCD, and that is not quantitative, what is the word here? Quantum chromodynamics. I made a video on QCD and somebody said, I came for quantum chromodynamics. It's something along the physics line that way over my head. I have no clue. So just giving you a heads up there. Donor advised fund, qualified charitable distribution, and then you have something where you can just directly give stock. So you can actually directly give the stock to an organization. They all work a bit different in how these are. So first, the donor advised fund. The way this works is that you can give to a donor advised fund, and you're able to then say, you know what? I want to give to the advisor fund or advised fund. I want then to direct this money in 5 years. You don't have to direct it today. It's a pretty cool option. I just talked to a client recently. He's thinking about doing it. And basically, he's going to pull 3 years worth of giving, put it in the donor advised fund so that he can take one large deduction on his taxes. And then, in 3 years, he'll distribute it out as he sees fit or over that 3-year period of time. Now, some people, if you look at it, donor advised funds do have a few drawbacks. There is the idea that some funds, they will say, hey, you know what? We will direct it however you wish to direct it, but they actually do have control. There's been some issues, I guess, there where a couple of the funds have said, you know what, we're doing certain things with the money that we want to do. Another thing is that money is oftentimes managed, so there's a money management fee for that, even though you want all of the money to go to the charity. Hopefully it does grow in the market if they're investing it, but there is a fee there. So just a couple things that, you may hear of that pros and cons when it comes to the donor advised fund. Now the QCD, this is probably my favorite of all, though unfortunately not everybody's going to qualify. You have to be 70 and a half years old to be able to do this. Now you can give up to $100,000 directly out of your IRA to a charity. And that basically what's going to happen is that the money that you're giving, you're not showing it as income. It's just going directly to a charity. Now, the nice thing about that is let's just say that you made that $100,000 this year and you were 70 and a half and you said, you know what, I'm going to give $10,000 to my church. Well, you can give $10,000 to the church. It's not going to show as income, so it's not going to bump you up, but you're not going to pay any taxes on the money. Plus, you can still take your $27,700 or $13,850 standard deduction there. So you've got some options. You're not paying any taxes on this money, so you're giving more money to the church, basically. If you take $10,000 and you say, hey, you know what, I'm going to reduce it by whatever my rate is. I'm going to give them $8,500, maybe it was 15%. Now you can give the whole $10,000. There's no income. You still take that. All right. So you get what I'm saying? I get excited when it comes to the QCD. Now, again, you can only give up to $100,000, and there's a catch with this one. You can't take the money, put it in your bank, and do all these different things. It has to go directly from the IRA. So a qualified charitable distribution goes directly from the IRA. The check needs to be made out to the third party, to the church, or to the 501c3 that you're giving to. So just remember that. Now, another one that's really cool is if you have stock that has appreciated. Let's just say that, you were in this whole NVIDIA rush of AI. And you bought NVIDIA at, let's just say $100, and now it's sitting at $450. Well, you've got some large gains there. Maybe you owned, 100 shares of this or something. But what ends up happening with the directly giving through stock is if you wanted to give to an organization, you could actually take the shares of stock. You're going to give it to them at face value. You can take the deduction on that. And the company that you're giving to, because they are exempt from paying taxes, is going to be able to take that money as it is and avoid ever paying any long-term capital gains on it, short-term capital gains, anything like that. So that's a super cool option. It's going to be able to help save you as well, because you're not going to have to realize any of the gains on that if you give it directly to them. So those are 3 different options plus just the standard ordinary one. Now, one thing that I wanted to mention though with this one is if you're giving non-cash assets, if you're giving stock, it's actually not a cash asset. So you can only do 30% of your adjusted gross income for the year. So just remember that when it comes to that one there. But that's really just a quick breakdown of how this works. This is the kind of stuff that we like to talk with clients about, try to come up with different strategies here at Jazz to help people just make their dough last longer, make it go farther if you're giving to a charity, and just help them out. So if you have any questions, if you want to check out a financial planner, money manager, we'd be happy to help you. You can check us out, jazzwealth.com.